Hi, everyone.
Good morning, everyone. It's Sanam Solati, Yurczyk with New England Prestige Realty.
I'm Kelly Turner with Total Mortgage.
Yeah, and we've had a wild ride the past few days.
And really it's in mortgage world.
It's
where
in
it's been
mortgage
wild.
world, but it impacts the buying and selling world.
Yeah. So let's talk about the few pieces of big news here.
Yeah.
So the most local piece of big news is CHFA, or the Connecticut Housing and Finance Authority, has run out of money for Time to Own for the third time.
Yes.
Time to Own was a grant program for borrowers who had lived in Connecticut for at least 3 years, and it awarded them up to $50,000 towards the down payment, a non-repayable down payment. So it was a great program. It was very popular. We have run out of money 3 times.
Yeah.
So it's been moving.
But that doesn't necessarily mean it's going to come back, right? There's no guarantee.
There is no guarantee it's going to come back. CHFA has indicated right now that it is in the governor's budget for the next fiscal year that they should be refunding it, at least a portion. But it is not a guarantee.
No.
We don't know. Now, this does not mean CHFA programs are gone.
No, they're always going to.
Yeah, there's still other CHFA programs available. Yeah. There's still other down payment programs available, but this particular program is suspended for the moment. So we don't have it.
But even though it's suspended, it wasn't necessarily the best program for many borrowers, actually.
Yeah,
right?
It was really tricky. So it was unique in that it had a low back-end debt-to-income ratio. So we have 2 debt-to-income ratios, your housing ratio, and then your full debt ratio. Yeah. But then you had to be over a 30% housing ratio. So we called it threading the needle. You were threading the needle with every house, trying to get the front end up high enough, but keep the back end down low enough. Oh. So it was tricky. The other situation that was tricky about it is the amount of the grant depended on the town. There were these area census tracts that we had to use. So like in some towns you might get $10,000, and sometimes you're going to get $25,000, and sometimes you're going to get $50,000. So it was a lot.
It was a lot. So there's a lot of red tape, which for some people, like, it made complete sense, but it really made sense for the people that wanted to find their forever home.
Correct.
Right. You're going to be there 20 plus years. Then it's a really great program.
Well, that is the other thing, is that it is a forgivable grant in increments.
Yes.
So you're only getting 10% of it forgiven every year for 10 years. So if you decide you don't want this house or need to move within the first, you're going to essentially owe, and it'll come out of the proceeds of your house. So you're not going to have to necessarily pony it up in cash, but you're going to owe 50% of that grant back again.
Yeah. So for the transitional buyers, it may not have been the perfect.
Correct. And we were trying to have really good conversations with borrowers ahead of time. Like, do you understand what you're getting yourself into? Yeah. Does this make sense for you? We also had to prove residency for 3 years. So you had to have been a Connecticut resident for 3 years. That for some borrowers is tricky. So yeah, it was a very unique program. Lots of states have done it. Massachusetts had one called Mass Dreams, which was similar. Theirs is also suspended for the same reason. But it was a great program. It was a tricky program. It's a gone program.
Yeah. Yeah. And that's okay, because we have a new hierarchy of loans that have taken the lead.
So you're a listing agent in the last 2 years. You're getting offers. What offers reigned king?
Cash. Conventional, with as much down as possible. And then maybe FHA.
Kind of everything else.
Maybe VA, maybe CHFA. But really, that was it.
So what is about to happen, and it's sort of interesting to me, I was telling Sanam that it's not really being talked about by anybody, is Fannie and Freddie have come out with a new set of what us in the mortgage world call LLPAs, or loan level pricing adjustments.
You guys have a lot of funny
We have so many acronyms.
I'm still learning, and I've been in the business for 26 years.
That's because you're excellent. You and I are excellent at being experts in our
in my lane. Yes.
So an LLPA is a loan level pricing adjustment, and that is the parameters of your transaction situation that impact your interest rate. A lot of people think that interest rates are interest rates. We get that a lot. People will call and they'll say, "What's the rate today?" There is no rate today.
You mean line and see blah 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 mortgage, and it says my rate is this? That's not true.
That is not true. That is usually what they consider their average daily rate within a certain set of parameters. So there's usually a little asterisk next to it, and you click on a link and it will tell you this rate is offered as of today for borrowers putting 50% down with an 800 credit score. It'll have all these requirements.
Yep.
Okay. So what sort of things impact your interest rate? Well, the number one thing is credit score.
Yes.
What amount is? and what you're buying the house for.
Which
So
makes sense because
your
it's the
down
risk.
payment, exactly.
How much of a risk are
you putting 3% down? Are you putting 5% down? Are you putting 20% down? So it's the loan to value. There's also things that property is it?
Oh.
A primary home, a secondary home, an investment property.
Yes.
What type of property is it? Is it a single family home, a condo, a multifamily home, a PUD? All of these have loan level price adjustments. Where things have gotten a little crazy is we have new LLPAs that were just given to us that have changed the game. So it is impacting borrowers in the like 720 to 760 range. Okay, so really good borrowers.
Yeah.
Putting a lot down, but not a full 20% down. So it's the 80 to 85% down when loan to value people. So meaning people are putting 10 to 20% in that range down. They are getting some big impacts on interest rates. And it's not going to be pretty and it's going to be really confusing. The other thing that's coming into play is historically, debt to income ratio really only impacted your interest rate when it moved programs for you, not within a program. Debt to income ratio is now going to be a moving target as far as interest rates are concerned. So what does that mean? If you are a borrower and your debt to income, so 40 is the cutoff where there's a big LLPA if you go over 40, and a conventional loan can go up to 47.
Yeah.
So
that just means your total debt cannot exceed more than either 40 or 47% of your total income.
Exactly, of your monthly income that's coming in. I mean, we say total debt, we mean everything that reports on your credit plus the new mortgage.
Yes.
Okay, so people get confused. I don't have that much debt. There's a new mortgage that we're calculating.
You will have debt.
A
good debt.
A good debt. But, if we're estimating, say, $120 a month for homeowners insurance and you're at a 39 DTI and you get your quote when it's $180 a month and now you're at a 40.1, we could see interest rate impact. So it will be harder for loan officers to really be estimating all of the parameters upfront. That's stressful for us. Loan officers, we have to issue at the beginning of the process. We try to make them as accurate as possible. But this is going to take away our ability a little bit to be as accurate as we were before. So what's the grand scheme of this, though, is conventional loans just got a little more stressful.
Yeah, which is insane. Well, your rates have been climbing up a little bit.
Yeah, this has been a rough week for interest rates.
Yeah, what week is it? Today's February 23rd. I'm I don't even know.
We had a CPI report that did not come in last week, how we wanted it to come in. And it's really just been rocky since then. So rates are honestly back to where they were in November and December.
But buyers are still out there. People are still house hunting, spring fever is in full effect.
Yeah, well, and I think the real trick with this is people are going to look for alternatives to make the mortgage process more affordable.
Yeah.
At the same time that Fannie and Freddie have announced essentially they're going to make it more expensive to buy homes with these LLPAs, FHA has done the opposite. So they have lowered the MIP, which is the mortgage insurance premium. That's the mortgage insurance on an FHA loan. They have lowered it.
Which is amazing.
Amazing.
Is there a rule of thumb on how much your private mortgage insurance is on let's say a $100,000 or $200,000 loan?
No, because all of those. So for private mortgage insurance on a conventional loan, it is tied to the same things that an interest rate
everything
is.
else. So the whole package. So that's why it's really hard. We'll get borrowers or buyers that'll be oh, my friend got this interest rate, and why can't I get this interest rate? It is the whole package, not only you as the buyer, but the property, just like Kelly said.
Exactly.
It's so many moving parts.
So and rates do change day to day, hour to hour, week to week. So if your friend locked a week ago, their rate can look really different than your rate will look like today.
Yeah.
The other piece to this FHA business is that FHA rates are generally lower at the moment.
Okay.
So what is that going to do? So in the spring, I have a feeling we are going to have very well qualified borrowers who would normally go conventional.
Yes.
Go FHA.
Because it makes sense. So I have a question for you, because I'm sure inquiring minds want to know, can I still be an FHA borrower and put over 20% down?
Correct. You can put whatever you want down.
You can put whatever you want.
For FHA, FHA
as little as 3.5%, but you can go as high as. Can you put 50% down?
You can put 50% down. There is no end to what you can put down on an FHA loan. So for some borrowers, despite the fact that you have mortgage insurance for the life of the loan on most FHA, there are circumstances with larger down payments where you may only have it for 11 years, which is not short, but for 11 years. There is circumstances around that. But for some borrowers, even with the mortgage insurance, because of the lower rate and the lower mortgage insurance, their monthly payment, which is what most people are focused on
Yes.
in a purchase. It's not really about interest rate. It's not really about mortgage
What's your
insurance.
affordability?
Is this affordable? It is going to be more affordable for them to go FHA. Now, that is going to be a shock for sellers.
So actually, this should be more for sellers. Sellers, tune in. We need to be open-minded.
Yeah, you're going to start seeing, houses that, even a month ago would have gotten 3 or 4 conventional offers, might see those offers as FHA offers now.
That's insane. So really, I mean, the only difference for sellers is that like health and safety items just need to be addressed. So little things like peeling paint, anything broken, like handrails, like simple
broken
things.
windows.
But really, any buyer should be able to buy a home with those simple basic needs anyway.
And that's a conversation that if you are thinking of listing your home, you should be having with your trusted realtor about, is this house FHA ready? Especially I would say in the range of, any houses, because of their loan limits for FHA loans, anything really in the like 450 and under range for a sale price, you really should be discussing, could I take an FHA buyer with this house in its current condition? Because that is going to maximize the offers that you're going to be able to accept.
Absolutely. Absolutely. And in this market, again, like people think that all homes sell, but like I think last year in this town, about 6% of the homes didn't sell, they expired. And there's a reason for that, right? So yeah, I think this is great.
So what's my real message for today is, number one, get educated. So if you are a buyer or a seller who is in the spring market, it's time to have some conversations about loan products, loan types. Realtors, it's a time for you to be educating your sellers that things are changing.
And that's the thing with our whole business, like fluid was the word, like we have to be fluid, right? Change with whatever is kind of thrown at us. But with FHA buyers, like they can still get full-blown mortgage commitments, and they should. You should. If you are out there looking for a home, you should work on getting a full-blown commitment.
Absolutely. And it's the easiest way to get an offer accepted. And I have had borrowers who've had a full-blown commitment for an FHA loan, get that offer accepted over a kind of shoddy conventional, online lender pre-approved. But I do also think it's a time for creative lending. It's a time for both buyers and sellers to be looking outside of the traditional box of a conventional loan versus an FHA. Again, I think CHAFA is really going to come into play in this spring market. Even though the time to own program is gone at the moment, the other CHAFA programs can be excellent. VA borrowers, a lot of VA borrowers have been hesitant to use their VA benefit in the last 2 years. I think it's time to pull those right back out again. But it's time to
It's all situational though. It is all situational. And so like talking to your real estate professional, like they will guide you. Cause again, it's based on each market and
the price point. That's the other thing. The price point does make a big difference. Your agent is going to do their due diligence to talk to the listing agent, see what kind of offers are on the table, what we can do to be competitive. And that's really the trick here is that what can we do to be competitive? And every house is going to look different.
Absolutely. Absolutely. Well, guys, thank you so much for watching.
Yes. If you have any questions, comment below, contact us. We're happy to help.
Also, we're still waiting on some more names.
Yes.
Like we've gotten some private stuff, and I don't know, we need more names in the hat, and then we'll put a poll out there. Yay. So put your creative hats on and send us some awesome names. So.
Sounds good. Thank you.
Thank you. We'll see you soon.